This video will work through problem 4.9 from Gapenski's Healthcare Finance 6th edition. Okay, so I'm going to use Excel this time because there's a lot of numbers and, my messy handwriting and all that. So we're given some information. First of all, that Oak Street is a not-for-profit, and it began 2015 with a list of balances, which I've typed into Excel here for you. And then it gives us a list of transactions, and we're asked to construct the balance sheet and income statement. Well, in order to construct the balance sheet, I think a good idea would be for 15 would be to construct the balance sheet for 14, or the year end of 14, which translates into the beginning of 15. So let's do that as kind of a starting exercise. And I think I'll do this in column format because then we can line them up side by side. So first things first, we've got to have assets, and we're looking in this list for our assets, right? And first thing we want is our current assets. Well, what are current assets? Things that are cash or could be converted into cash or will be used up or potentially used up in the current year. So cash, of course, is number one. We'll put that over here. Accounts receivable are also a current asset. However, we have doubtful accounts. These are accounts receivable this is our estimate of how much, our estimate of the portion of our accounts receivable that won't be collected. So then we want net AR, right? And that would be the 245 minus the doubtful accounts of 227. So we have to be careful here with this statement that we don't wind up adding this twice. Okay, then inventory, so supplies inventory, and what was that? Accounts payable, right? Not AA. Okay, so this equipment is a long-term asset. Accumulated depreciation goes with equipment. Accounts payable is a liability. Notes payable is a liability. Net assets is the equity account for a not-for-profit. So be careful with that. That is not total assets. That is net assets, which is how a not-for-profit refers to their total equity. Okay, so we don't have any more current assets. So I'm going to do total current assets, and I'm going to add cash plus net AR plus the supply inventory for 321. And I didn't just sum the column because I didn't want to double count all that. So our current assets at the beginning of 2015 are 321,000. Then we have equipment of 1.5 million, but we have accumulated depreciation on the equipment. Let me widen that out. There we go. So we have net PPE equal to 1.5 minus 300, or 1.2 million, and they don't have any other assets, so that makes it pretty simple. So total assets are the 321,000. The 321,000 in current assets plus net PPE gives us 1.521 million. Okay, then we can just continue down here. Liabilities and owner's equity, or in this case, we call it net assets just to kind of remind us. Net assets, right? And so we have, in terms of current assets, current liabilities, we have the accounts payable, and we have and then notes payable can either be long-term or current. And if you saw this in a real in a real balance sheet, they would distinguish between the two, and you could actually have notes payable current and then notes payable long term. Let's treat that as long term. So we'll have total liability, current liabilities equal to the accounts payable, and then we have notes payable. Then we would have total liabilities equals 500 plus 21. And then we have net assets equals, sorry, I don't need to do an equals. I just need to copy that over. There we go. Yep, I'm happy with that. And so total liabilities and net assets equals the net assets plus the total liabilities for 1.521. Okay, and yay, total liabilities, sorry, total, let me wrap that. Total liabilities and net assets of 1.521 equals total assets. So that tells us our balance sheet is in order. So year ending December 31, 14, right? That's our first, so that's our starting balance sheet. Then we're going to have a year ending December 31st, 15. Okay. And then we're going to need, so to get there, we're going to need ultimately the income statement and all the other transactions that we're going to look at. So let's look at the transactions and figure out what we need to do. All right. So first transaction, we billed patients for services rendered 1.7 million. So let's see, how do we want to do this? Okay, to capture all the transactions, I've created a transaction worksheet. And so what I'm going to do is go back to my other sheet here and fill in the top row with all the numbers that I already know we have starting the year. Okay, thanks to my ability to stop the recording, I filled all that in and you didn't have to sit there and watch me do it. So now we can look at transaction by transaction, how this affects each of the accounts. So we bill patients for, transaction one is we bill patients for services rendered of 1.7 million. We bill patients, so that means we've done some care, and we have booked revenue. So starting with booking the revenue of 1.7 million. And then if we've billed them but we haven't collected the money, then we're going to have an increase in accounts receivable of the same amount. So accounts receivable. Next, we purchase medical supplies on credit. So line 2, medical supplies on credit. So that means inventory is going to go up by 12,000. And then our our accounts payable is going to go up by 12,000. We haven't used the 12,000 yet, so it won't show up in the supply expense yet. Okay. So notice the inventory, which is an asset, went up, and liabilities went up. So we're keeping our balance sheet in balance. Next, employees earned 712,000 in payroll. So we're going to we haven't paid them yet, right? They've earned it, but we haven't paid them yet. So we owe them $712,000 in, and our salary expense has gone up $712,000. Okay, next, we pay the employees $683,000. So at the point at which we pay the employees, we reduce our accrued salaries by the amount that we pay them. So 683, 1, 2, 3, and that becomes a salary. Well, that's already a salary expense. Because we paid them, we pay in cash 683, 3. So staying in balance here. Annual depreciation on equipment. So our equipment, we're accumulating more depreciation, 150, 1, 2, 3, right? And then that is also an expense, 150, 1, 2, 3. And notice I'm always doing two transactions that counterbalance each other, right? So, for example, when I did, when we had 1.7 million in patient service revenue, I booked it here under accounts receivable and over here under revenue. So you always have a balancing transaction. These accounts, the liabilities accounts, so from J to L, the liabilities accounts are in J to L. The equity account is column M, and then the asset accounts are D to I. Eventually, these are going to create our income statement. N to R is going to collapse into net income, right? Which, given that this organization is a not-for-profit, ultimately I'm not going to pay out any dividends, and so any net income that this organization earns converts into net assets. So eventually all N through R are going to collapse down into column M. So if I do a transaction over here, it can counterbalance the transactions on the asset side. Okay, so basically, I'm going to have, every time I do a transaction, I'm going to do one on the asset side, and one over here from J over, and that'll represent the liabilities and equities, or I'll do two on the same side, but I'm always going to do two. So for example, so we did 1.7 in assets, and then we did 1.7 million in revenue, which is part of the equity. So it's kind of on the liabilities and owner's equity side. The next one we did was we purchased 12,000 in inventory on credit. So we did a transaction on the asset side, and then we did a transaction within the liabilities to balance it out. The next one we did was 712,000 on the liabilities for accrued salaries, and we did 712,000 in expenses. This is actually going to be a negative, right? So all of the transactions are happening on the right side of the balance sheet with the liabilities and owner's equity. Because this is being booked as an expense, it's actually got a negative. So if you add if you subtract, because it's an expense, 712,000 from positive 712,000, you have zero. So that's in balance. The next transaction we did was we paid 683,000 of the salary obligation. So we paid it in cash, and on the asset side, and it reduced our liabilities on the liabilities and owner's equity side, right? So here you have a transaction over here on the asset side, on the left side of the balance sheet, and then broadly over here on the right side of the balance sheet. Here, let me make this a thick line. That way we'll really, maybe we can visualize that a little more. So they made that dividing point a little thicker so we can get left side of the balance sheet, right side of the balance sheet divided by that thick black line. All right, so fifth transaction, reviewing here again, fifth transaction was annual depreciation. So we are increasing a contra account, right? So this is going to be subtracted. But we're also increasing a contra account over here, which is expense. So these are both subtractions. So it's negative 150 and negative 150. So they balance each other out because they're on both sides of the divide. Okay, so transaction 6, we receive a bank loan. Okay, receive a bank loan. So cash increases by 250 because we get the cash from the bank. We're probably going to buy something with it, but cash increases by 250 and notes payable increase by 250. Right. Transaction on the left, transaction on the right, balancing each other out. Seventh transaction is we have cash collections on patient billings. Okay, so in the amount of 1.124 million, so we get cash of 1.124 million, and our accounts receivable goes down by the same amount, 1124000. Right? So this is two transactions on the left side of the balance sheet that counter each other out. If you add these two together, you get 0. So that's okay. You can have both transactions on the same side as long as they counter each other. The next is estimated bad debts for next year. So we're guessing that the amount of bad debt that we'll have against our accounts receivable is going to be 44,000. And that's really kind of a negative. And then we're going over here to the income statement side, to the income statement portion of the net assets section. So we're over on the right side now, and we're going to increase our provision for bad debt for 44,000 for this coming year. The ninth transaction is we make a payment on the bank loan. So we make a payment, it's a cash payment of 75. And our notes payable goes down by, sorry, that should have been a negative. So we make a payment, so it's cash goes down by 75. But happily, our notes payable goes down by 75. And then finally, we use medical supplies in our patient care. Okay, so when we actually use the inventory, we reduce it by we're using it up, so we don't have as much. And that's when we recognize it as a supply expense. So we don't recognize, even though we bought $12,000 in inventory earlier in the year, that's not a supply expense until we actually use it. So we don't actually use that until down here. All right, so that's those are all our transactions. So now we're going to total them up. So we just total the column. And here's where Excel comes in handy. I can just copy that across now. Okay. Now, how much, so going back to so we have all these subtotals. How much net income does the organization earn in this year as given the transactions that we've had? Well, we had 1.7 million in revenues minus our allowance for bad debt minus our salary expenses minus our depreciation. And then I made a mistake here. Let me pause for a second. Okay, the mistake I made, you got to be careful with this, is remember all the expenses are actually negative, right? So when I wrote decrease of 10,000 in inventory over here for line 10. I should have left that positive because it's being booked as an expense, so it's actually a negative. Okay, so sum all that up. Oh, and I left out the depreciation expense. Minus the depreciation expense, and we get 784,000 in net income. Right. So then we can. What we're going to do is we have net assets were $1 million, not 100,000. All right, fix that quick. There we go. We can do a final total. And really the only thing that changed was net assets. And then to clear these out, we want to have a countering entry because we're using them all over here. One more zero. And we're closing out the the income statement entries. So we can zero them out. Some accounts are zeroed out at the end of each year. Okay. So we have revenues of 1.7 million, less bad debt expense, gives us our 1.656 million. We had 712,000 in salary expenses, depreciation expense, and supply expense. Okay, so now we have all the information we need to go ahead and finish off our balance sheet and income statement. So let's start with, let's build our income statement for the year, which would actually be called a statement of operations because this is a not-for-profit. So the income statement starts with revenue, right? So patient service revenue was equal to 1.7 million. Then we had allowance for a provision for bad debt. We can call them, whatever. Provision for bad debt was equal to 44, but it's actually a negative number, so I'm just going to make it negative. So we have net patient service revenue is equal to this plus the provision for bad debt. Let me neaten that up a little bit. There we go. So we have NPSR. We don't have any other revenues. So then we just have then we want our expenses. So what were our expenses? Salary expense, depreciation, and supply. So we have salaries, supplies, depreciation, total expenses. So let's go grab our salaries. Our supplies, and our depreciation. Sum that up. And then our net income is net patient service revenue minus total expenses is 784. Right? And if we go back here, that's what we had calculated a minute ago. Okay, so we're on track. We're good. Now, this is going to be easier because we have all these numbers already set up. So we just go grab cash. Our cash balance of 686. our accounts receivable of 821, our allowance for doubtful accounts 2, our net accounts receivable is going to be 821 minus the allowance. Supply inventory and I'm going kind of back and forth and grabbing from the top line and the bottom line there. It doesn't really matter. So then we sum up our net assets plus, our net accounts receivable, our supplies, and our cash. We don't want to double count. I'm not including these two because that's already here. So we have 1.471 in current assets. Then our equipment, 1.5. Our accumulated depreciation is 450. Our net PPE is the 1.5 million minus the 450. So our total assets are the net PPE and the current assets. And then now we need to get our liabilities and net assets. So our accounts payable is equal to, we'll go back here to accounts payable, get our 33. And we don't have any other, we do actually have a new current liability. So we're going to insert here. And we're going to put in what's our new current liability. It is accrued salaries. And we got to grab that value. And then do we have any other? Well, notes payable we could treat as a long-term. We're going to treat it as long-term. So sum up our total current liabilities. So our notes payable now so total liabilities is notes payable plus current liabilities. Net assets, we already calculated, went up from 1 million plus 784,000 in retained earnings, gives us 1.784 million. So then we just need to sum our net assets. Oops, got to put an equal sign. Our net assets and our total liabilities, and we get 2.521. Let me neaten this up a little bit. Okay, so our balance sheet for the end of 2015 is in balance, 2.521 in total assets, 2.521 in total liabilities and net assets. We built our income statement here, right, and showed total net income of 784,000. And so that, I believe, is that.